Hey everyone, my name is Ryan Bolton and I am a mortgage nerd. Welcome to the Mortgage Market Report. This is where I'll find information I think is pretty relevant to the mortgage industry, the real estate industry, and just the market in general. So I found a couple tidbits that I wanted to release today as part of this new series. Most days I am going to talk about the MBS. This is the mortgage backed security market that affects interest rates more than anything else out there. That's really what determines interest rates is the MBS or the mortgage backed security market. When you see it's positive, that means interest rates are better. When it's negative, that means rates are worse. So right now, at the time of this recording, we're about 15 basis points better. I've seen it as high as 19 today, as low as about 13, other than right at the opening mark. So we've been kind of staying around that 15 all day. And that's good news. That's helping interest rates. We saw about a 200 basis point loss just a little while ago. And so we're starting to kind of chip away at that and get back down to where we were before they realized they weren't going to cut the Fed's funds rate in February or in May, like they were talking about, that inflation isn't quite down where they wanted it to be yet still. So they're just kind of waiting to do that cut. And so there's a lot of anticipation they were going to do that. So the rates are kind of following that trend. And as soon as they didn't, or the numbers didn't support cutting the Fed's fund rate, you saw the bond market kind of shoot up. And a lot of it becomes reactionary, like a run on the bank whenever you get into the 100 or 200 basis point swing. So usually you see it kind of chip away and kind of come back down, maybe not all the way back down to where it was before, but at least a little bit closer as reaction kind of gets worked out of the system and we start to actually see true data. The next thing I wanted to mention was home prices. The home prices that Black Knight and CoreLogic reported showed that for March, we were up 1.2%, for February, 0.7%. So that's actually pretty good, strong indication of home appreciation. It's still more resilient than interest rates. A lot of it has to do with supply and demand. There's still more demand than supply. Sure, it's slowed in both supply and demand, but there's still more demand than supply, even with the interest rates the way they are. And so as a consumer, I look at that and say, okay, if you're waiting for interest rates to get better, how many other people are waiting for the same thing? And if you still only have a certain number of homes on the market, you're going to have a huge uptick in demand, which is all of a sudden going to be higher prices. We saw it during COVID was a perfect example. You had this big rush in demand in certain areas. There wasn't enough supply, and people were listing their home at 400, but it was selling for 450, 500. People were overbidding on that home because there was so small inventory. There was so many lack of homes to choose from when demand really kicked up. And I see that's getting primed right now. So hopefully we will see rates improve. Everybody wants to see interest rates improve, especially in our industry, and just for existing home sales to kick up a little bit. But we do want it to be more slow. We don't want it to all of a sudden go from 8 to 5 or something crazy like that. But the appreciation is a good indication that the market is still trying to kind of catch up to what's happening and that we are still seeing appreciation. We're not seeing a housing crash like they were talking about all last year when rates are going to go up, houses were going to crash. We're really not seeing that. We're getting more to a normal appreciation. And I would even say if you add those two together, it's almost a 2% growth in February and March. That's probably still a little high. That appreciation number is still high. I mean, you're supposed to see that maybe in a year, maybe in 8 months, not in just two. But we always see a little uptick going into the spring, kind of summer months because the holidays are over. People are kind of coming out of hibernation with the snow seasons are starting to have that spring season kick up. You also have kids getting out of school, so you start seeing people want to relocate to different districts or maybe downsize or upgrade or downgrade. Whatever they're doing is easier when the kids are out of school, when families can move. And so you're already starting to see those numbers start to uptick a little bit, but we're not seeing them go down. We're not seeing a negative appreciation by any means. We're still seeing positive numbers there. Next thing I want to talk about is oil prices. That affects inflation a lot. That affects supply and demand, getting goods and services all over the country. A lot of it requires diesel and requires the price of a barrel of oil has actually dropped by $10 roughly, down to about $78 a barrel because the U.S. production's increased by about 7%. Now, most of that could be a response from OPEC. They've been cutting their supply a little bit, but there is always a little bit of an uptick knowing that supply needs to uptick a little bit because demand usually also increases in the summer months. People move around more, vacations, traveling, relocating. There's more movement and more gas that is used in the summer months than obviously the winter months. So there's always a little bit of an uptick, but I was surprised to see it actually went down by $10. So that's an interesting indication that, again, supply is kind of kicking up a little bit to make sure it's ready for any kind of increase in the summer travel. But we should still see gas prices get worse in the summer, but that's an interesting indication they may not get as worse as we thought, and then maybe another way to help goods and services continue to move across the country. The next thing I wanted to talk about that many people don't know about, there's a global supply chain pressure index. So this is an index that kind of shows how much pressure there is on the overall global supply. It's actually down by 0.8%, 0.85% from a negative 0.3% from the previous report. So it's even showing that there's a little less pressure on that supply, which should help with prices, which should help with moving goods and services, and should help with the inflationary numbers, that you don't just have such a bottleneck in the supply, which again makes it so there's more to choose from, so the prices can be cheaper, that you're not having as many people trying to buy the same amount of services and goods by having more of that available. So it should help with the prices. So what it really is showing is there is a lot more pressure to for deflation, to actually have inflation continue to go down, which is what they've been fighting now for 2 years. And you're starting to see that the things that they're doing have been able to help to get inflation back under control. So all good news, I think, for the mortgages, good news for real estate. Really is a good report, and hopefully we'll continue to see this trend work its way out. So it looks like we're down to about 12 basis points. Yeah, so we kind of keep bouncing around 12 basis points, 15 basis points on the MBS. So I hope you found this interesting. Please like, subscribe. I'll try to put this out every day and just kind of give you a market update on what's out there. Looks like the bond market's going to have a 30 or 3-year treasury today. I think that's about it for today. So hope you found this interesting. Please like, subscribe, comment below, and we'll see you on the next video.